Right, in business, the International Monetary Fund, IMF, has announced the disbursement of a 150 billion shilling facility to Kenya, with 99.6 billion shillings expected to be disbursed immediately. This is after the sixth review of the 2021 facility that was aimed at easing fiscal pressure post-pandemic. The review has also called for fast-tracking of structural reforms to enhance export competitiveness, strengthen public financial management and state corporations, and address weaknesses in governance and anti-corruption framework, including anti-money laundering and combating of terrorism financing in Kenya. Jimmy Mbogo with more on this latest review.
According to the IMF, the sixth review of the Kenyan facility now brings the total disbursement under the extended fund facility and extended credit facility to an average of about $2.6 billion, an equivalent of 419 billion shillings, with the IMF board now calling on the central bank to continue to act decisively to ensure that inflation converges firmly to the target, insisting that the strength of the monetary policy framework would support price stability and external sustainability, further noting that the exchange rate should be allowed to respond flexibly to the market conditions. According to economist Churchill Ogutu, the loan will serve to improve the FX reserve, signaling an effect that could see Kenya receive more financial inflows from the World Bank and other syndicated loan lenders.
We expect that in a couple of days we can get some syndicated loan, and also the World Bank is also scheduled to make some disbursements sometime by March this year. So all that is coming in at a time whereby we are looking at a Eurobond maturity in June, and this will help Kenya to be able to make that particular payment.
Contrary to expectation, the IMF notes that Kenya's growth remained resilient in the face of increasing external and domestic challenges, an assertion that comes despite reports of a diminishing disposable income for majority of Kenyan households owing to high unemployment rate and an aggressive taxation measure put in place by the Kenyan government.
This is a discussion also the board had. I think there are several factors that are leading, and I think the report clearly points out the underperformance in revenue. When you look at growth, overall growth is strong. A lot of it is coming from the agriculture sector that has been highly impacted in the last 2 years because of the drought, and there's a significant rebound. And given a lot of the agricultural sector is subsistence, it's not, it doesn't contribute to taxes. But if you look at the non-agricultural sector, a lot of it is recovering, but it's because of the tight policy environment, economic activities are much slower than where we anticipated, and hence the collection of taxes also.
The IMF further notes that in the near term, Kenya's outlook will be characterized by continued resilience, with growth projected at around 5% in 2024, despite an increased inflationary pressures for the first half of the year on the back of global oil prices volatility and exchange rate pass-through, which they say will be contained due to the recent monetary policy tightening.
We don't think Kenya will default on the Eurobond. And the discussion yesterday and the board's approval of the review and the additional funding is in recognition of that. I think we see this truly a liquidity pressure where, I think Kenya will be able to navigate through the different sources that they're receiving to address this.
Jimmy Mbogo, Citizen TV.